Hello and welcome to Mint Funds Update. My name is Marek Krzeczkowski and I'm joined by Ryan Falls. Today we will talk about market outlook and what happened within our funds in January. Just starting from the US economy is going very strong. Still we see unemployment at 4%, which is below long-term average. And in terms of activity, both services and manufacturing are in expansion. Another thing to point out is the inflation and the fact that we all know that inflation came off from the high levels of 2022 and now back around 2%. We did see a bit of an uptick in December in inflation, and as a result of that, we saw interest rate expectations for 2025 being repriced. So here on the right-hand side, we are showing you expectations for the US funds rate in red. That was levels in September 24, and in green in December. So as you can see, markets are expecting a lot less interest rate cuts than previously. However, we believe that this inflation will continue, and we are fairly confident at this point that inflation will remain in the range that will allow central banks to respond if there is a contraction in the economic growth in the US. Obviously, the biggest question mark at this point is President Trump and his policies. So far, we have seen a lot of actions mostly focused on deportation and cultural issues. We've seen a lot of executive orders. Many of them have been challenged in courts. And obviously, the biggest question is around tariffs. Again, we saw announcement of tariffs for Mexico, Canada, and China, and then Canada and Mexico were reversed. It was 25%. Now, the reason the markets have not reacted that much was that markets were fearing a lot worse outcomes. So before the election, we were talking about 60% tariffs being a possibility. Now, 10% for China is obviously not great, but it's not anything that markets would be panicking about at the moment. And finally, just touching on AI, we see the US technology capex going up in 2025. We expect that to continue. The interesting thing was what people call a DeepSeek moment. That was a Chinese AI that was released last month, which created a bit of a stir because suddenly they came out saying that they've managed to train their model for the fraction of the cost that OpenAI and other competitors have spent. However, for us, we believe it's a good news, because if it's true that you can have a low-cost AI models, that means that the broader market should benefit from AI adoption. On a day when DeepSeek was announced, we saw a drop in stocks that were obviously, the likes of NVIDIA has dropped a lot, companies that provide services for AI. But in terms of our portfolio positioning moving forward, we believe that as we have an exposure in portfolio to a broader market, in 2025, we should see an adoption of AI in other industries, and as a result, EPS growth that would follow. I'll just hand over to Ryan.
Thanks, Marek. So yeah, I'll just quickly touch on the New Zealand domestic economy. So in January, we had the Q4 CPI release. So this is a quarterly release, and the Q4 CPI showed that inflationary pressures have all but now receded in New Zealand. We slayed the inflation beast. However, deteriorating New Zealand dollar has led to a small bump in tradable inflation, as you can see in the chart here, but from September to December. And then non-tradables is on trend to settle down, hopefully around the target range between 1% and 3%. As you can see, the headline number is effectively at 2%. There's it's effectively plateaued between September and December. So with non-tradables above 4 and tradables below 0, the combination has led the headline below that, around that target range of 2%. Turning now to the two diversified funds. So we'll start off with the diversified income fund. So Looking for January, we had plus 0.9% for the month, so asset class performance was broadly positive in January, with US headlines on tariffs and trade wars dominating headlines, along with some AI developments out of China. Drilling into the actual asset classes, so global equities are our best performer, plus 0.6%, so the largest contribution to the overall performance, with Australasian equities contributing plus 0.3% and fixed income coming just flat. Turning to look at the positive contributions, so we'll quickly talk on fixed income first. So we've seen long end interest rates move widely over January as markets digested news on the US tariffs, and then also the Q4 New Zealand inflation coming at 2.2%. Our short duration positioning actually paid off as interest rates broadly rose in January, and this helped offset the move up in rates and its effect on the market value of the bonds. Within global equities, we had Boston Scientific Corp up plus 14.6%, and Thermo Fisher Scientific Incorporated, which is up 14.9%. They were our top two contributors for January. Thermo Fisher had a very strong end to the month after announcing consensus-busting revenue and earnings results. Within Australasian equities, we had Telix Pharmaceuticals up 19.2% and Megaport up 15.6%, and they were top two performers in the Australasian equity sleeve. Telix surged after news of it completing on two mergers of Imogen AB's innovative biology technology platform and then also RLS. Turning now to the negative contributors, within global equities we had AMD down 4.1% and Comcast down 10.3%, and they were the main two detractors. Comcast disappointed on results at the end of January, undershooting earnings and also future guidance, with subscriber growth being the main headline miss of 1.369 million subscribers, or 139.6 thousand subscribers versus 100K expected. Within domestic equities, we had Serco down 1.8% and Skellerup down 1.6%. Skellerup moved down slightly towards the end of the month on some analysts forecasting a slight increase in costs to their business for importing Chinese products into the US due to the introduction of tariffs by the Trump administration. Turning now to growth, so growth funds up plus 2.8% for January, and again, yeah, asset class performance was broadly positive for the month, despite all the headlines on tariffs and trade wars. Turning to each individual asset class, so global equities is up 2.5%, that was the largest contribution. Then we had Australasian equities coming in second at plus 0.3%, and then again, fixed income coming in flat. Within global equities, again, we had Boston Scientific Corp up 14.6% and then SAP up 12.9%. Boston Scientific popped on news that they had agreed to acquire Bolt Medical for $900 million. That's a firm that specializes in equipment for decalcifying arteries. Within Australasian equities, again, we had Telix Pharmaceuticals and Megaport. So Megaport actually bumped up on news that they announced a new point of presence facility at two data centers in Europe with its recently announced strategic partner, Enlighten. And then again, within our fixed income for the growth fund, our short duration positioning helped mitigate the effect of interest rates rising on the long end of the curve. Looking at the negative contributors within global equities, we had AkzoNobel down 5% and Comcast Corporation again down 10.3%. AkzoNobel slid slightly after reporting earnings at the end of January, indicating that after posting a lower Q4 net profit number, they didn't expect the market to rebound this year. And then within domestic equities, Serco down 1.8% and Stride Property Group was down 1.5%. They were the main two detractors. Stride suffered as the longer end interest rates increased and then appeared to buck the wider trend against some positive performance in the real estate investment trust sector within New Zealand for January.
Okay, thank you for listening. If you have any questions, please send them to info@mintasset.co.nz.